What's going on out there, good people? It is your boy Look Around with LMD Trading, and we are back. We are back with something a little different than the usual daily trade reviews, or different than some of the tutorials that I've posted out there. Today, we are going to be diving into long-term investing and trying to answer the question of, is it a good time to start making some long-term investments? We do know that the market is in a downturn right now. U.S. economy as a whole, I think, is in a downturn. But should we be waiting to try to find the bottom, or should we be investing now, knowing that we're going to be holding these investments for the next 10, 15, depending on your age, possibly 20, 30 years if you're young. Something that I'll admit I did not even think about in 2008. But going back and looking at some numbers from 2008, I can kick myself. So I've been having some discussions with some buddies and been throwing it around asking, like, should we be investing now? So what I did was went through, grabbed a bunch of different stocks and seeing what the 52-week high was, going back 52 weeks, seeing where the current price is, seeing whether they're down or up and what that number is. Then I went back to 2008, found the lows for 2008, found the lows for 2018. So 10 years from 2008, went to 2018, seeing what those numbers were. We know COVID was 2019, 2020, seeing what those numbers were. And then seeing where we're at today in an effort to see, okay, if you had purchased in 2008, what would it have been worth 10 years later? If you purchased in 2008, what would it be worth today? And if you purchased during the COVID period, what would it be worth today? I think you'll be surprised with some of these numbers. Some of them, not that spectacular. In a few cases, some of them are actually negative right now. But the overwhelming majority, the returns are pretty impressive. And with this spreadsheet, I made it to where you can play with the initial investment amount, but this would have been a one-time investment, or possibly could have broke it up into 4 investments and just made 4 singular investments. But the thinking in my mind when I made the spreadsheet was that it was just going to be a one-time investment. And then we'll also discuss a platform that's out there that you can do long-term trading on, which is M1 Finance. M1 Finance allows you to create a pie. They call it a pie. You break your slices down based on the stocks that you want to invest in. I am by no means a financial investor, so I would not tell you what to actually invest in. I will be showing my M1 account probably at the end of the video, so you'll see what I personally have purchased. But one of the gentlemen that I listen to on YouTube, he gets asked all the time, what should we be investing in? And his simple answer is, what do you use on a daily basis? What products, what services do you use on a daily basis? I personally own an Apple phone or an Apple phone. I own an iPad. I have an Apple Watch. So take a look at Apple, see if Apple is a viable company. If so, think about investing in it. Energy, a lot of different energy companies out there. Check the energy sector out. One that everybody should be involved in is some type of ETF, such as the SPY. Vanguard has the S&P 500 ETF. You have the Qs. Those are investment vehicles that they have a group of stocks already inside of them. And then you can put that into your portfolio. But let's go ahead. I did this spreadsheet in Excel. So let's go ahead, let's dive in and let's see what these numbers are showing. And let's see if I can catch the right button. And we did. All right. And if you done stayed around this far, please go ahead and hit that like button. I do think that you will find this information valuable. But this here is a spreadsheet that I created. Like I said, I took a group of stocks, different sectors, different markets. You got some technology. You have some stores. We'll run down it real quick. You got Apple. You have Amazon. CCL is Carnival Cruise Lines. They're getting hammered right now. You have CVS, it's a drugstore. CVX, that's Chevron, it's oil and gas. You got Delta, you got Ford Motor Company, Home Depot, Microsoft. You have the ETF, the Qs. You have the ETF, SPY, Tesla, and then Walmart to round it out. These are just sorted in alphabetical order. This column here shows you the 52-week high. So going back 52 weeks, what was the high that stock was trading at? Current price that it's trading at as of today. I'm making this video July 3rd, 2022. So that's the current price. I call this column the discounted column. How much is that price, or how much is that stock discounted from the 52-week high? And look at these numbers. Look at Carnival. Carnival is discounted 88%. And you might ask, why did I call it discounted? For one, that's what it is. It's that much cheaper than it was 52 weeks ago. But we as consumers, we as people love to buy things that are discounted. If we can get a deal on something, we always for it. So if you could buy, let's say Delta is discounted 44% from where it was at last year. Ford Motor Company is discounted 56%. Tesla discounted 45%. So if you can buy something at a 45% discount, knowing over the next 10 years, you can get your money back, why wouldn't you want to take advantage of these discounted prices? Now, can these prices go lower? Of course they can. Of course they can. Of course these stocks can continue down lower, which I'm sure they probably will. But do you want to sit around and try to wait for the bottom? Or do you want to start taking advantage of those lower prices now? And if they continue to go down, you just continue to do what they call dollar cost averaging. And every time you buy, it just dollar cost averages where you was at the last position. So if they keep going down, your dollar cost average will keep going down. And then when the stock turns and it starts going back higher, then your dollar cost average will start going up. But again, we're looking at the long term. We're looking at a minimum of 5 years that you really do not even want to look at these once you start purchasing them. 10 years, okay, yeah, that's when you really want to start seeing what your money is doing. But these are not purchases that you're going to want to buy and wonder what it's doing 6 months or a year from now. You'll look at some of the ones from COVID and you'll see like, yeah, you would have gotten some great returns on your investment. But again, we're looking long term. And once we go through these numbers, we'll look at some charts just to see that no stock goes down and stays down. If it's a viable company, the key word, a viable company. You can get some companies out there that's fly by night. That's not what we're looking to invest in when we're doing long-term investing. You can do that when we day trade because you're looking for volatility. But long-term, looking for companies that's been around for a while. Now, you can put some riskier companies in your portfolio that's kind of volatile, but I would say that would be a small percentage of what's in your portfolio. But let's continue looking at these columns. So next column that we have here is number of shares that you could have bought in 2008 spending $1,000. And how I came up with this number here was I took the low, so this was the low in 2008 for these particular stocks. I multiplied it by 25% because you will never, ever catch it at the very bottom. So I figured 25% would be a good number to say that you got into it. Again, this is a one-time purchase. This is a one-time purchase. You got $1,000 laying around. You're going to buy any one of these particular stocks. And I can change this number and we can see what it'll be. Basically, though, all you'd have to do is add a zero if you were going to make that a $10,000 investment. Take a zero away if you were going to make that a $100 investment. But these are the number of shares that you would have been able to buy right there. Again, this is the 2008 low. This is 10 years. So 10 years from there, 2018 average. That's what the average was over 2018. And this here, if you had spent $1,000 in 2008, in 2018, this is what that $1,000 would have grown to. Again, that's a one-time purchase. So if you'd bought Apple, you would have been able to buy 283 shares, and that investment would have been worth $12,430 in 2018. This number is already minusing your initial investment. Amazon, that would have been worth $36,000. Carnival Cruise Line, you would have doubled your money. You would have been up $2,100. CVS Drugstore, you would have doubled your money. Chevron, it wouldn't have doubled your money, but you would have made a profit. Delta, you'd have made about 10 grand, and you can see what the rest of them. Walmart being the only one, Walmart and CVX, where you would not have doubled your money. Both of those are stores, like consumer stores. So we see that the tech market did good. We see that the travel industry did good. And that was over a 10-year period. So then I went and I looked at COVID. And before we go there, one of the guys that I like to get information from, Jared Wesley over at Live Traders, he said that, and I'm not sure where he got this information from, that in our lifetime, there will be usually two opportunities where we can catch the stock market in a downturn. So I'm 48 years old for next couple of weeks. I would have had 2008. Wasn't really that market savvy in 2008. So I wouldn't have really been looking to buy stocks like that. I have a couple of books on my desk, and I probably purchased those books back in that time. Never did anything with them. One of the books, I actually flipped it open when I found it out in my workshop and turned to a page that was describing what Jared Wesley calls the buy setup. And I'm like, wow, I had this information in my hand all these years ago, never looked at it. But that's what he says. You usually will get two times in your lifetime. So first time, 2008, didn't take advantage of it. Second one, we had COVID, 2019, 2020. I did take advantage of this one. I did. This is really when I really got into my investment minded, my day trading minded mentality, because me being involved in the travel industry, I saw what the travel industry was looking like. They were getting hammered. I remember Delta was trading at about $62 a share. It had a low of $17.51 during COVID. I took advantage of that. Spirit Airlines, I bought some Spirit. The one that I didn't buy, that I hate that I didn't get, was Carnival Cruise Lines. It had gotten down to $7. We see in that 52-week period, it was up to $72 a share. And I'm sorry, $7.80 was its low. It's back down again. It's back down discounted. I will probably add that one to my long-term portfolio. May not be a very big portion, but I will add that to it. But that's what this column is showing. Basically, COVID lows. This column here shows you 2022 lows. And you can compare that. That's about 2 years, 3 year difference. This column here is if you purchased in 2008, what would that investment be in 2020? And that's what these numbers here are showing. Like I said, on a couple of them, going to 2020, if you had held through 2018, there are a couple of them that are in the negative now. They are trading actually lower than they were trading in 2008. We'll look at the charts and you'll see, would you have really wanted to hold those that long anyway? Because even with long-term investments, you still want to have some type of stop in place. So these were the numbers for 2020. But let's get down to what I'm going to call the meat and potatoes of this thing. And we're going to look at if you had invested during COVID, where would you be at? And then if you invest now, what can you expect in the future? And we'll look at that and try to see if we can get it based on the charts. So this column here is saying if you purchased in 2019, 2020, this is how many shares you would be able to buy of each of these stocks. And this is what it would be worth right now. This is current prices. And let me make sure. Let me click this one. So this is saying K2, 2222 lows. You're taking N2, a little education with Excel. So it's taking the number right here, is multiplying it by 1.25. So that's adding 25% to that number. It is multiplying it by 2022 low. And then it's subtracting this number out of it. So this is not even basing it on. This is not even basing it on the current price. This is just saying for the 22 lows. So this is just taking where the low is. So this could actually be a little higher because I'm looking at some of these numbers and they're trading higher than what the 2022 lows are. But let's get back on task. So if you'd have bought 19 or 2020 in 2 years, that $1,000 would have made you $2,600 on Apple. Would have made you $245 on Amazon. You look at CVX. CVX, you'd be up $1,200. So it's actually grown more than from 2018. Ford Motor Company, $1,700. The kicker, let's go down here and look at Tesla. If you would have spent $1,000 on Tesla during the COVID era, catching it not quite at the bottom, you would have been able to buy 12 shares, or let's round it down, let's say 11 shares. You would have been able to buy 11 shares of Tesla, and at COVID or at 22 lows, so 2022 lows, it would be worth $7,800 right now. And we see right now it is $60 higher than that low is right now. So that's another $600. You'd be up about let's realistically say $8,000. That's on $1,000 investment. I think that there just speaks volumes in itself, because we're actually getting back down, getting close to some of these 2022 lows. We see that most of these are not the 2022 lows, but some of these getting somewhat down near the COVID lows. We'll look at the charts and you're going to see that most of them, they got a decent little gap that they would have to get to. But do you want to try to wait and see if it drops down to that? Or do you want to start taking advantage of these discounted prices and just slowly start working your way back into the market? So let's go ahead. Let's bring up Thinkorswim real quick. We'll look at a few charts. And like I say, I have no problem showing you my M1 Finance account. And I'll drop a link in the description if you want to open up your own M1 Finance account. So these two lower charts are the ones that I'm going to be paying attention to primarily. This is a yearly chart. Every candle here represents 1 year. Every candle here represents a week. This chart goes back 15 years. So this takes us right back to 2008. I'm going to maximize this one for right now. And I'm going to start at the top. I'm going to start with Apple. And when I say trying to find viable companies, Apple, this is one that I have in my long-term portfolio. It's a company that I use. But look at Apple from 2007, 2008. 2008, it was trading at $2.79. That's crazy. But look at how it's just grinded up. This dotted line is the 200 simple moving average. And we see that it just continued to come and it tested it and bounced off of it. Tested it, bounced off of it. And I have these lines on the chart here. These were just like support areas. So if you look, this right here is COVID. This is COVID. It used this area right here as support, and it bounced and then it took off. And then it's just been in a little uptrend. It's been kind of pulling back. That was a little heavy pullback. But looking at it, there was no real area in this weekly chart to kind of give it some support. Maybe right there. Probably could have dropped the line there. That should have held it. But came down, caught this next area of support, and that's where it held it. Came back up. Now we see that it didn't set a new high. Then it came back and it kind of M-topped, and now this is where we're at today, now in today's times. It's going down. So we see, I just dropped that line there. Look at what it did. It's using this area right here as support to try to hang on and possibly start back going higher. It's a good chance it's going to come down. If it does, it'll probably come down to this area right here. So we could see Apple get down to 122. But again, we're talking long-term investing today. We're not looking at what it's going to do. We're looking at, if we purchase today, what are the chances that this thing is going to fall and not come back? Or, like I said, should we be buying now and then just saying, okay, 10 years from now, we're going to be good? And one thing I did want to mention in my example with the spreadsheet, I said that was a one-time $1,000 investment. What if you took that $1,000 and you bought $250 right now? And then it did come down to this leg right here. And then you bought another $250 worth. And then let's say a week, 2 weeks later, you bought another $250 worth. Until you spent your $1,000. You could possibly catch some as it's falling lower, or it may start going back up and you'll start dollar cost averaging in on its way up. But my thing is, get in the market. You can't take advantage of the market unless you get into the market. This one here, this is Amazon. Amazon, the same way Apple was for the past, since 2008, has just been on a steady climb. It'll pull back right to the 200 moving average, came up, just kind of slow grinded its way up. I'm gonna show you one thing on this one though. This is a little more in depth than what we're doing here today, but let's take this and let's go 2 points. We're gonna go those 2 points and then we're gonna extend this to the right. Look at how that came down to that. It came down to that. Look where it came down to now. Now that it's gotten below this, it's gonna bounce off of that. It can either go higher and break back through it. Most likely it's gonna use that as resistance, push it back down. Again, we'll drop a line right here. Uh-oh, let me change that back. I'm sorry. I'm actually getting a little more detailed in this than I kind of wanted to, but I just love technical analysis. Let's drop that line right there. Look at where that support is. It's using this area of support to hold this. Think of that as the ceiling. So this is like the ceiling holding it up. If it busts down through there, now the ceiling is going to become the floor. But again, purpose of this vehicle or this video is long-term investing. So what if you have $1,000 that you could spend. You spend $250 right now. 2 weeks from now, it has broken through this level. You spend another $250 or you spend $100. Whatever your pockets can stand, that you just get in the market with. With my M1 Finance account, I opened that end of March. I put $100 a week in that account. It auto drafts it in my basket of stocks. When you put your stocks in there, you have to account for 100% of that pie. And then out of that $100, every week, M1 Finance will go out and they will buy what my $100 will allow me to buy. That's me. That's my way of getting in this market right now with the thought process of 10 years from now, we could see those same returns that we saw from 2008 to 2018. That's my thought process on this. Let's look at a couple of them. I'm going to show you some that's not quite as clean as this is. These are clean. Like I said, these are the ones, these long-term. That's what you want to see, just a steady climb. This here is a little nasty, and I'll speak on one other thing before I move from this chart. You'll hear a lot of investors say stocks will take the stairs up. This is the stairs up. This is taking the stairs up. Here, it took the elevator up, chopped around. It took the elevator back down. So usually stocks will take the stairs up and the elevator back down. But once they take the elevator back down, they will take the stairs back up again. So that's just an example of it taking the elevator. It's quick. It's just a quick drop down. And it did that because it took the elevator going up right there. Same way you come up, most of the time, same way you're going to go down. But let's look at Carnival. Carnival is an ugly chart. This is not one that I would probably put into my long-term portfolio disclaimer, because it's not in there, but I will possibly put it in there. This is one of those ones that I would just have a small percentage of my pie in this one, just because of how discounted it is right now. Just because of how discounted it is. We see that this thing chopped all over the 200 simple moving average. Most of the time, stocks, they respect the 200 moving average. And we see that it's using it. It's using it all over the place. But there was no real just uptrend pattern with Carnival Cruise Lines. It's all over the place. But again, one that I'll possibly put in my long-term as one with a little higher risk on it. Here we have Delta. Delta's a little choppy up until 2012. Then we see it kind of got on a decent little uptrend. Bam, what do we have there? That is COVID. Wicked elevator ride. Look where it came to. It used that area right there as support. Once it got through that, came down, kind of tested that area, caught traction, started its way back up. So we'll come over here and look, and we see right here, it's kind of using this area right here as support. Most likely going to break through there, and we'll probably see this back down at $25. Again, right now it's discounted 45%. So this may get discounted a little bit more. But do you want to try to wait to the bottom? Or do you want to get into the market now with what you can afford? Again, it could be $20 a week. It could be $50. You have some people out there that they can afford to put $500 a week into a long-term account and it not affect their pockets today or tomorrow as far as paying bills. But just think about what you can afford and taking advantage. That's my thing with this, taking advantage. Home Depot the same way. It has just been on a smooth climb up. Home Depot is one that is in my long-term portfolio in M1 Finance. We see right here, this is COVID. Slam down. We can come over here to the left. As Jared Wesley with Live Traders always says, Beyonce, think Beyonce, to the left, to the left. You always want to look to the left for your areas of support or resistance. All I did was came here and dropped a line. Look at what it did. I came here and dropped a line. Look at what it did. I can come up here, drop a line. Look at what it's doing. So we know now if this gets below this, which is actually converging with the 200 moving average. If it drops below that, we could drop one right here. We'll see that it used that one there before. We might see it down here around 256. If it gets below here, it has this one area here, and then it's coming down. So you can take your $1,000. Again, you buy $250 right now. You come over here and you say, what's that? $265. If this gets below $265, I'm gonna wait till it comes to this next level. I'm gonna spend another $250. Or if you have $100, I'm gonna take $25 and buy right now. I'll take in 2 weeks, I'll spend $25 more and buy it. Usually it's going to go down a leg or it's going to go up a leg in a few weeks. Again, emphasis on this is take advantage of the market while it is discounted. What is Home Depot discounted right now? Home Depot is down 35% right now. You can't tell me if you went in the store and they told you, hey, you could buy this, it's off 25, 35, 88%. You would not want to take advantage of it. This is the SPY. Same way, it's been on a steady climb. The day that the market does not go back higher is the day we have bigger things to worry about. Again, COVID. We see COVID dived it. We can come out here to this area here, drop a line up. Wasn't trying to do the study. There we go, drop that line. See, this almost came down to that area and tested it. Probably could have dropped that line right there. Look where it came to, right to that area. Tested it, caught traction. You could have bought at $225 a share in 2019. 2021, that same share would have been worth $479. On one share, you would have doubled your money. Think if that was 10 shares. Or think if you had an M1 Finance account and you were just putting $100 a week into it, $100 a month into it. Again, whatever your pockets can stand. You were putting that into that account. You might have only been buying 0.1 share. You do that 10 times, you're going to own 1 share of it. You do it 10 more times, you'll own 2 shares. So that's the thought process. We look at stocks like Tesla. Tesla's at $680 a share. We say, oh, I cannot afford a share of Tesla. You got $100 going to that account. Let's just say you put 75% of it is allocated to Tesla. Every week it's going to buy $75 worth of Tesla. 10 months, you'll own a share. 10 more months, you'll own 2 shares. And in 10 years, how many shares would you own and what would those shares be worth? So I hope y'all can kind of see what I'm saying in this video. And I'm gonna look at one more. This is Walmart. Again, Walmart testing 200. It held strong. We come out to 2014. It finally broke below it. We see it came back. It was resistance now. The ceiling had now become the floor. Finally got through it. COVID somewhat hurt it, but not much. But look at the recovery from COVID. Again, let's say you bought 1 share right there, 108. It would have been worth $160 2 years later. That's what I want y'all to understand. And right now, Walmart is in a precarious situation because it is below the 200 now. We come here and we can use that area right there as support. If it drops below this and it can't get back above it, it might use that little area there, and then it might take a ride. So again, I'm not saying that you're getting the best price on it right now, but what I'm saying is take advantage of the price right now. Take advantage of it. Look at, if you don't use M1 Finance, there's a lot of companies out there now that are allowing you to fractionally buy stocks. I know Webull, I just seen that they're letting you fractionally buy and they're letting you kind of build a pie. But I like M1 Finance. I'm sold on it. One of the guys I listen to, he talks about it because he uses it, and I like it. So I'm gonna go ahead. I'm gonna show you my pie. Let me bring it up on the other screen, and then we'll take a look at it, and then we will be done. So I started this account March 26th. And from then on, actually March 28th, I'm off by a couple of days. Every week, I put $100 into this account. Right now, it's down $245. The market is ugly right now. But guess what? I'm looking at this 10 years out from now. We're in one of those pullbacks right now. We're in a pullback. So you see I come up and pull back and it go. This is my investment. This is my actual account. It goes up, it pulls back, it goes up, it pulls back, it goes up. That's the market. That's what the market does. So I'm looking at this 10 years out, 15 years out, depending on your age, 30 years out. Think about it. If you just invest in $100 a week, $50 a week, again, whatever your pockets can afford, you just investing. What can that account look like in 20 years? But this is my pie. Like I said, in no way am I trying to tell people what to invest in, but these are companies that I use, companies I know. Amazon, The Spy, Apple, Tesla. Actually, I'm interested in buying a Tesla car, but the price is a little crazy right now. Home Depot, I'm a homeowner. I'm in Home Depot probably a few times a month. ABBV. This was one I don't really know too much about, but the guy who turned me on to this particular investment vehicle mentioned ABBV because of the dividends that they pay. And actually, if you look at it, it's not down that much. It's only down 0.48%. I probably should be investing more into that one. Got AMD, Disney, and Intel. And then over here tells you how much I have allocated, the weight of my account. So I have Amazon weighted more than any of them. I'm going to be going in and changing this. I did this when I kicked it up to 20 around the time that they were splitting. So we know that Amazon was trading in the thousands. Once they split, it ended up splitting their price. I think they went 20 shares to 1. So now I actually own shares of Amazon. I own 2.72 shares of Amazon. So over the long term, Amazon could get back up to $1,000 a share. We never know. But again, I'm in these for the long term. I'm in these for 10 years. Wish I could just delete the app and not worry about it, but that's my thought process on it. But I hope y'all enjoyed this video. Probably went a little longer than I expected to, but if you stuck around, again, give me a like. Let me know down in the comments what your investment, long-term investment goals are right now. Are you doing any long-term investing? If not, hopefully this video might change your thought process on it. Maybe want to get looking into it, because I'm sold at looking at the 2008 numbers in 10 years, how much those numbers grew. Let me see if I can hit the right button again. I got these screens a little different. I'm going to change this to $10,000. You can easily add a zero in your head, but when I do it on here, if you spent $10,000 in 2008, in 2018, that would have been worth $124,000. Think about that. Amazon, $10,000. That would have been worth $362,000 in 2018. You held it to 2020. A $10,000 investment in 12 years would have been worth $500,000. That is the numbers I'm talking about. That's the numbers I'm talking about right there. 10 years from now, the money that you spend today, what will it be worth? We know if it sits in the bank what it's going to be worth. We know that. We know it's going to be worth not even 1% interest that you're making on your money. But if you invest in some of these viable companies, not a fly-by-night, but a viable company that has a shown track record and has been around for years, they fully like grounded in U.S. consumer or worldwide consumer, where will that money be in 10 years? Think about it. Think about it. And then we'll come back and revisit this video in 5 or 10 years and see what it's looking like. But on that note, I'm going to go ahead and wrap this one up. I have some curry shrimp that I just seasoned up, and it's marinating, and I can smell that it's ready for me to get it in the pot. So I'm going to wrap this one up, and we'll catch you next time. Peace.